Investing feels like a secret club with a language you don't know. The good news is there's a simple, boring plan that actually works for beginners. Buy the S&P 500 and automate your money. In this video, we break down how to start without guessing games. You'll get a practical routine you can follow month after month and year after year. First, what is the S&P 500? It's a collection of about 500 large U.S. companies. Buying it through an index fund means you own a tiny piece of many businesses at once. Why beginners love it? It spreads risk because you aren't relying on one company to carry the whole load. Over the long run, it tends to grow with the economy, which is enough for most people who invest for decades. Before you invest, fix the base. You should have an emergency fund that covers 3 to 6 months of essential expenses. This money stays in a safe place and is not invested in the market. Also, tackle high-interest debt. If you have debt charging high rates, paying it down can beat the market in the long run. Get that sorted before you start large stock bets. Choose your vehicle. Look for a low-cost S&P 500 fund, usually an ETF or a mutual fund. Popular options include VOO, IVV, and SPY, all offering broad exposure with small fees. Keep fees tiny. Fees matter because they quietly reduce your returns over time. A fund with a fee under 0.1% is a reasonable target for most beginners. Where to put your money? You can use a taxable brokerage for ongoing growth, and you can place much of your long-term money in a retirement account if that's available. The key is consistency, not trying to time the market. The 4-step plan you can start today. Step 1 is to clear the basics. Step 2 is to automate. Step 3 is to review. Step 4 is to learn, gradually and consistently. Step 1 is to finish your safety net. Aim for 3 to 6 months of essential living costs in a separate savings account. This creates a cushion that helps you stay invested when headlines scream doom. Step 2 is automation. Set up automatic monthly transfers into your S&P 500 fund so you don't have to decide every month. It keeps your habits steady even when life gets busy. Step 3 is picking the fund. Choose a widely used S&P 500 ETF with low fees and decent liquidity. Look for funds with transparent tracking and reliable issuer backing. Step 4 is not timing the market, it's rebalancing. When your balance shifts due to market moves, you buy a little more to keep your mix roughly the same. This simple action reduces risk without guessing future prices. Step 5 is review cadence. Review every 3 months. In a short session, check your contributions, fees, and whether your plan still fits your goals. Step 6 is a learning habit. Create a tiny learning ritual. Read one short article a week about investing and write one paragraph about what you learned. Step 7 is journaling. Keep a simple investing journal. Note why you started, what you saved, and how you felt about market moves. Step 8 is understanding risk and horizon. The S&P 500 is volatile, but a longer horizon usually smooths the ride. Your patience is the advantage, not your timing. Step 9 is a withdrawal plan. Plan for retirement or big goals. The auto-investing habit helps you grow while you work toward those milestones. Let's imagine you're 28 and you start with $50 a month. You auto-invest in an S&P 500 ETF and forget about it for years. Over time, you increase the amount as you get raises, bonuses, or windfalls. The power comes from consistency and time, not one big win. Now consider someone starting with $200 a month at 35. The same plan scales with their life and still aims for decades of compounding. When markets dip, you don't panic. You keep buying automatically and you stay the course. The habit wins because it ignores short-term fear. People want flashy stories, but the boring plan often wins. Chasing hot stocks tends to hurt returns and adds emotion you don't need. The opposite mistake is ignoring fees. Even a small difference in fees compounds into a big gap after many years. A few tenths of a percent can matter a lot. Emotions lie to you in the market. A steady routine helps you outlast fear, greed, and impatience. The plan is your calm center in a noisy world. Time is your friend when you invest regularly. The sooner you start, the more you benefit from compounding. Small, consistent steps beat big, irregular bets. Price is what you pay today. Value is what the company earns over time. And the S&P 500 aims to reflect overall value. Don't chase price swings. Follow the trend of broad earnings and growth. Dividends add a small but steady stream of cash into your account. You can reinvest them automatically or take them as income, depending on your goals. Either way, they accelerate growth without extra effort. Within retirement accounts, you won't pay taxes on gains until you withdraw. In a taxable account, you may owe taxes on dividends and capital gains. Taxes aren't the enemy, but they matter for long-term planning. Some people swap a part of their portfolio for international stocks. For beginners, the S&P 500 option gives enough exposure to avoid complexity. You can add foreign exposure later if you want. When a crisis hits, the plan keeps you going. The habit matters more than any single price movement. You'll feel the urge to sell, but your rules keep you steady. Talk about your plan with a friend or family member. Accountability helps you stay on track. Explaining your approach makes it more real. You won't become an expert overnight. Small steps compound into skill over time. The goal is progress, not perfection. Your life will change, and your plan can adjust. Increase your contributions as your income grows, or trim if money is tight. Flexibility keeps the habit alive. Today, you can set up your first automatic transfer, pick a fund, and write down your learning goal. These tiny actions move you from thinking to doing. Keep it simple, invest in plain language, and rely on a few trusted sources. You don't need a finance degree to start. The basics are enough to grow. That's the core idea. A straightforward, repeatable habit built around the S&P 500. The boring parts are the strong parts and the ones that actually compound. You deserve a plan that works without drama. Like this video if you want more clear, practical investing ideas. Subscribe and comment with your plan or questions.